Hello everyone, you're welcome to my channel Promotion for Sure. In this video, we are going to talk about market risk. Now in this chapter, you will learn concept of market risk in banks, market risk management framework, value at risk, back test and stress test, general approach to market risk mitigation. So if you have clicked to watch this video, be rest assured you have reached a channel that will give you a treasure of knowledge, and that's a promise. So please subscribe and become a lifetime learner. Now let us start the chapter and let us learn different concept of market risk. Now banks have several activities and undertake transactions that result in market exposure. They are not immune to these risks and have to face them too. All such transactions are reflected in the trading book. So, a trading book consists of banks' proprietary position in financial instruments covering debt securities, equity, foreign exchange, commodities, derivatives held for trading. The trading book also includes positions in financial instruments arising from matched principal brokering and market making, or positions taken in order to hedge other elements of the trading book. Now, what is market risk? Now, market risk is the risk of adverse deviations of the mark to market value of the trading portfolio due to market movements during the period required to liquidate the transactions. The period of liquidation is critical to assess such adverse deviations. Trading liquidity risk. Trading liquidity is the ability to freely transact in markets at reasonable price. Trading liquidity is the ability to liquidate positions without affecting market prices, attracting the attention of other market participants. Now, trading liquidity allows one to transact without compromising on the counterparty quality. Liquidation involves asset and market liquidity risk. Price volatility is not the same in high liquidity and poor liquidity situations. Liquidation risk arises from the lack of trading liquidity and results in adverse changes in the market prices, inability to liquidate positions at fair market price, large price changes caused by liquidation of position, inability to liquidate position at any price. Now, what is credit and counterparty risk? We have already studied about it. It is the inability of the borrower to make the payments on time. That could be because of various reasons. Now, what is market risk management framework? Now, market risk management involves finding answers to four key questions. First, what are the risks? Second, what is the quantum? How much could the price change? What would be the effect of profit and loss? How can we monitor and control price risk? Can we reduce the risk? And if so, then how? Now, management processes are subdivided into following four parts: risk identification, risk measurement, risk monitoring and control, and risk mitigation. An effective market risk management framework in a bank comprises of risk identification, setting up of limits and triggers, risk monitoring, models of analysis that value positions or measure market risk, like risk reporting, etc. Financial instruments take their price from the market, and that depends upon the interaction of market variables. Hence, market risk management processes do not have a risk pricing process. Now, if you talk about the organization structure of market risk management, organization, it consists of board of directors, the risk management committee, the asset liability management committee, the ALM support group, market risk group, the middle office, etc. Now, the board of directors has the overall responsibility for the management of risk. The board articulates the market risk management policies and procedures, the aggregate risk limits, the review mechanism, and the reporting and auditing system. The board should decide the risk management policy of the bank and set limits for liquidity, interest rate, foreign exchange, and equity price risk. Now, the Risk Management Committee is a board level committee. The responsibilities of Risk Management Committee with regard to market risk management aspects include the following: setting guidelines for market risk management, ensuring that market risk management process conform to the policy, setting up prudential limits and their periodical reviews, ensuring robustness of measurement of risk model. Now, the Asset Liability Management Committee is responsible for implementation of risk and business policies simultaneously in consistent manner and decides on the business strategy to achieve these objectives. So, the role of ALCO is product pricing for deposits and advances, maturity profile and mix of incremental assets and liabilities, articulating interest rate views of the bank, funding policy, transfer pricing, balance sheet management. It sets up operating prudential limit and is the review authority of the line management. The ALM support groups analyzes, monitors and reports the risk profiles to ALCO. It also examines the effect of various possible changes in market variables and recommends the action needed. The middle office is responsible for critical function of independent market risk monitoring measures. It analyzes and reports to ALCO. Middle office provides the independent risk assessment, which is critical to ALCO's key function of controlling and managing market risk in accordance with the mandate established by RBI. Now, what is risk identification? All products and transactions should be analyzed for risk associated with them. This is something which is significant and should definitely be on. Usually, all standard products would have product programs for each of them. New products or non standard products may operate under the product transaction memorandum on a temporary basis while the full market risk product program is being prepared. Now, what is risk measurement? Now, market risk measurement framework is heavily dependent upon the quantitative measure of risk. The market risk measures seek to capture variation in market value arising out of uncertainties associated with various elements. These provide an objective measure of market risk in a transaction or of a portfolio. Market risk measures are based on sensitivity and downside potential. Now, what is sensitivity? Now, it captures the deviation of market price due to unit movement of a single market parameter. Now, supply demand position, interest rate, market liquidity, inflation, exchange rate, stock prices, etc. are market parameters which drive market values. For example, change in interest rate would drive the market value of bonds and forward foreign exchange held in a portfolio. So, if liquidity in the market increases, it may result in increased demand, which in turn may increase the market price. Now, what is basis point value? Now, this is the change in value due to one basis point, which is 0.01% change in the market yield. This is used as a measure of risk. The higher the BPV of a bond, higher is the risk associated with the bond. Computation of BPV is quite simple. Duration. Macauley's duration was first proposed by Frederick Macaulay in 1938 as a means of describing bonds price sensitivity to yield change with a single number. This is equivalent to time on average that the holder of the bond must wait to receive the present value of cash flow. In other words, this represents cash flow, which is center of gravity. Now, the duration of modified duration is Macauley's duration, which is discounted by one period yield to maturity. The longer the duration of a security, the greater will be the price sensitivity to yield changes and the higher would be the risk associated with the bond. So bond prices changes can be estimated with help of modified duration by using the following relationship. So approximate change or percentage change in price is equal to modified duration into yield change. Now, what is downside potential? Now, risk materializes only when earning deviates adversely. Downside potential captures the possible losses only and ignores profit potential. Downside risk is the most comprehensive measure of risk as it integrates sensitivity and volatility with the adverse effect of uncertainty. This is the measurement that is more relied upon by banking and financial service industry and also the regulators. Now, what is value at risk? Now, management of market risk is concerned with the question how much can we lose? The answer is that the possibility that we can lose everything with the although it may have very low probability. Now, value at risk attempts to create more useful answer by altering the question. How much can we expect to lose? Or what is the loss potential? The answer could be that we can lose a maximum of X over the next week and may expect that with 99% confidence. So, value at risk is defined as the predicted worst case loss at a specific confidence level over a certain period of time, assuming normal trading conditions. Now, if you have to do a comparison between yield versus price volatility, yield volatility is the degree of variance in the yield. This is largely unaffected by time and duration. The volatility rises as yields fall. Price volatility is degree of variance in price. This is largely unaffected by yield and substantially affected by time and duration. So price volatility is equal to yield volatility into BPV into yield divided by price. There are three main approaches to calculating value at risk. The correlation method, which is known as variance or covariance matrix method, historical simulation, and Monte Carlo simulation. All the three methods are based on three basic parameters: the holding period, the confidence interval, and the historical time horizon over which the asset prices are observed. Now, what is backtesting? Now, backtesting is a process where model based value at risk is compared with actual performance of the portfolio. This is carried out for evaluating new models or to assess the accuracy of the existing models. What is stress testing? Now, market value of a portfolio varies due to the movement of market parameters such as interest rate, market liquidity, inflation, exchange rate, stock prices, etc. Movement in market parameters on day-to-day basis causes the changes in the market value of the portfolio. This represents the normal risk that is associated with normal day-to-day movements. There remains the risk of large non-normal movement in market parameters that signifies abnormal market conditions. Risk arising due to such movements fall beyond the day-to-day risk monitoring, but that could potentially occur. Stress testing essentially seeks to determine possible changes in the market value of a portfolio that could arise due to non-normal movement in one or more market parameters. The process involves identifying market parameters to stress the quantum of stress and determine the time frame. Once these are determined, it is applied on the portfolio to assess the impact on it. Now, if we have to talk about simple sensitivity test, a simple sensitivity test isolates the short-term impact on a portfolio value of series of predefined moves in a particular market risk factor. Scenario analysis specifies the shocks that might possibly affect a number of market risk factors simultaneously. In an extreme but possible event occurs, it seeks to assess the potential consequences of a firm of an extreme but possible state of the world. Maximum loss approach assesses the risk of a portfolio by identifying the most potentially damaging combination of moves of market risk factors. Extreme value theory is a means to better capture the risk of loss in extreme but possible circumstances. EVT is the statistical theory on the behavior of trails. Now, what makes a good stress test? Now, a good stress test should be relevant to the current position, consider changes in all relevant market rates, examine potential regime shifts, consider market liquidity, consider the interplay of market and credit risk. Now, how should risk managers use stress tests? Now, stress test produces information summarizing the bank's exposure to extreme but possible circumstances. The role of risk managers in banks should be assembling and summarizing information to enable senior management to understand the strategic relationship between firms' risk taking and character of financial leverage employed and risk appetite. Limitations of stress testing can appear to be straightforward technique. Now, risk monitoring and control. Risk monitoring and control calls for implementation of risk and business policy simultaneously. It consists of setting the market risk limits or controlling the market risk based on the economic measures of risk while ensuring the best risk adjusted return. So, I hope this chapter would have given you a lot of valuable insight and you would have understood the concept of market risk. So if you like this video, you can press the like button, subscribe to our channel and share it on social media. Help us to spread education in this beautiful world. Thank you.